Your grandparents used to buy mutual funds, but now you can buy ETFs, exchange traded funds. They trade like stocks in the stock market, but they're very low cost. You can get direct access to indexes that way. Welcome to a Wiser Retirement Podcast. Are you curious why you would ever pay a financial advisor to invest in just low-cost ETFs? I'm Casey Smith. I'm joined today with Andrew Pratt, the king of data here at Wiser Wealth Management. Each week, we bring you practical advice on retirement, investing, and planning for your financial future. Don't forget to subscribe to the podcast wherever you're listening. Let's get started.
Good morning, Casey.
Good morning. So I've been excited about this topic. I honestly, I have in the last 10 years, I've never been asked this question directly. I think it's because we're able to show the value of what our firm does, which I don't want to give away. I mean, all of our clients already know what our value is, but I don't want to give away the entire podcast and right in the opening here. But let's kind of walk through this because I think it's an important question. I see it on message boards a lot. I'm just dating myself calling it a message board. But if you're looking at,
I understand that.
if you're looking at Reddit or you're looking at even just Facebook topics around investing, people go, why would you pay somebody 1.5% or 1% to invest in ETFs? You can do it yourself. It's really simple. And they have a point, but they're also missing some other points. So let's kind of dive right in, and I want to make sure we bring everybody along with us in this conversation. So let's start by quickly talking about what passive investing is.
Yeah, I think simply if you just boil it down, passive investing is just a simplistic way to invest, with a long-term mindset in something that's low cost that will maximize your returns. And this generally just means investing in a index proxy that, that tracks like a broad universe, whether it's, the US stock market, or it can get even to, a little bit more granular, like a sector, but it's, tracking this index risk and return characteristics, and not really, tactically making moves, our short-term trading necessarily. It's just really matching this index's return to risk profile.
So there's I would say 3 key indexes. There's the S&P 1500, which includes the entire U.S. market. Mm-hmm. Most people would just watch the S&P 500 on their local news right at night. But 1500 covers the entire U.S. You have the MSCI foreign index, which covers all companies outside the U.S.
Right. And
then you'd have the U.S. bond aggregate index, which covers all the bonds here in the United States, which is really the world's bond market. There's other bond markets, but this would be the largest, right? So with those 3 indexes, you can invest in probably over 6,000 companies.
Right. Exactly. There's countless indexes out there, but there's, a lot that are more prominent. The 1500 a lot of people do use the Russell 3000 just to capture the total U.S. stock market. And then even with ex-US or, excluding the United States equity market, there's the MSCI ACWI ex-US index. But then you can even get even a little bit more cute with that and, exclude certain countries or try to exclude certain countries. But, generally you can create a very efficient portfolio by investing in these very prominent indexes that capture most of the market share.
And most of these you can gather through Vanguard. They're low cost.
Right.
And you could buy them. And the idea, how they get built is they're really done by market cap. So the larger the company, the bigger weighting it has inside the index. The smaller company, the smaller the weighting that it has. And you would buy it and you would leave it alone. That's what passive investing is. It's an attractive investment strategy because, quite honestly, it works really well a long time. There's a study that comes out every 6 months called the SPIVA. It's all caps SPIVA index report. This BIVA report comes out and it tells you what these indexes have done versus active managers. And every 6 months, this is my favorite report. Every 6 months it comes out, and it is really telling that over the last 20 years, that very few active managers are able to beat these indexes.
Right. And I looked at this recently. I think, just for the S&P 500, trying to actively beat that index over the past 10 years, I think it was like, high 80 percentile that managers did not beat that. So again, it's very difficult to beat an index, especially something like the S&P 500, because it's very efficient. It captures, like 95% or more of the market. And again, it's the structure of the index, the market capitalization weighting. It's kind of we always say it's like a self-healing process, because, they have certain time periods where they rebalance and reconstitute these indexes, and they'll kick out the losers and add winners. And, that kind of structure has led it to be one of the best performing, if not the best performing index over the long run.
Take the conversation a step further. Your grandparents used to buy mutual funds, but now you can buy ETFs, exchange traded funds. They trade like stocks in the stock market, but they're very low cost. You can get direct access to indexes that way. And then kind of transitioning us a bit, we also have active strategies where you could also use ETFs to be doing more active management. So let's describe active versus passive.
Active is more, not necessarily hands-on, but more tactical, trying to time the market, trying to beat an index, which again is very hard to do. And because of this, these strategies always have higher fees because they're paying, there's more portfolio management involved. There's more, quantitative screens and processes involved in managing these strategies. And I think one thing that I was just sort of contemplating or thinking about is, active always focuses on just the return aspect. It doesn't really focus on risk adjusted return. So it's like we are trying to outperform the S&P 500. And, some strategies may do that, but are they taking a lot of extra risk to beat the S&P 500? So I think that's one thing that kind of gets lost in the, trying to assess and understand an active strategy. But yeah, the main goal is trying to outperform an index, and, there's, can have a lot of trading and just, tactical movements in that strategy.
So let's go back and revisit our question. Why do we need to pay a financial advisor to invest in low cost ETFs? Well, if the whole comparison is you have to take away the highest probable vehicle for success, which would be the ETF or the more passive strategy, right? Then I'm not exactly sure what the question is. You're saying you could do that yourself? It may be. But there's other things that go on even in managing a passive portfolio.
Right.
Unfortunately, a lot of these things are missed because there are a lot of advisors out there that will put you in a passive ETF portfolio, low cost, looks good. You're paying them 1+%, 1.5%, and you never hear from them. And then nothing happens in the portfolio. It just kind of sits there and stares at you.
Right.
And there are some portfolios that end up like that because that's the best thing to do. But for a mass majority, that's not exactly the case. So let's talk about just some benefits. First of all, firm models.
There's two sort of key areas, like the firm model structure and, maybe client portfolio specific, but firm model, there's, asset allocation. So most of our models have a high proportion of passive funds, but we're doing research, and a lot of it's rooted based on academic research for efficient model portfolio construction. But it's like, what proportion of U.S. stocks versus international stocks should you have? How many core bond, or what is your core bond position? So we're looking at those sort of different exposures underneath the hood and making recommendations based on that, and then just looking at where does it make sense to be allocated over the long term with these different exposures.
For example, if you went to Vanguard.com 10 years ago, even today,
right,
they have a tremendous allocation to foreign stocks. We have historically always been underweighted foreign stock, and we seem to get more underweighted every single year. And that could be a whole podcast in and of its own.
Yeah.
But it derived a very big performance difference between a Vanguard model that you pull free off the website versus what our portfolios have done.
Right. And there's, over the course of my career, there's been other institutions, Vanguard, JP Morgan, GMO, that have been forecasting low expected returns for US equities versus international equities for a long time. I kind of consider, is it them just trying to sell their other book of business to try to get people interested in their other investment products? But, a lot of their arguments are based on research, but again, what we look at is the long term, and we have, maybe a different view of some of these institutions, and it actually has worked out over time to be heavier weighted in US equities versus international equities. But that's one area that we are looking at. But we're also, I'm looking as the investment manager, I'm looking at portfolios and the markets daily, but we do a formal review at the investment committee level once a month, and we'll, address any kind of key areas that we deem that are necessary to look at. And then we'll have constructive debate, and then we'll make changes if it makes sense. And again, we have a long-term mindset. We're not trying to time the market, time any kind of noise that's out there, but we will make changes if we think there's a long-term paradigm shift. And if we believe it will be additive to the portfolio.
One of those examples is digital assets.
Right.
We waited till the ETF had matured a little bit, but adding digital assets to the portfolio, and it was an opt-in scenario because a lot of people just don't understand the asset class yet, and you don't want to invest in anything you don't understand. But that's an example. A new asset class is created. First time that's happened in 200 years.
Exactly.
So that's something that we can educate ourselves on, and then make that recommendation to the client that we add this asset class. Also, asset location would be another one, right? And how we construct portfolios. In that many firms will do this by looking at each individual portfolio as its own, where appropriate here, we look at all the accounts as one portfolio, and therefore for tax efficiency, we can place certain investments inside IRAs and certain investment inside brokerage accounts, or maybe Roths.
Yeah. And I think this goes down to the client portfolio level. If you have different types of accounts based on a tax treatment standpoint, we'll make it more efficient, allocate more efficiently by tax location, and or it's also called householding the accounts into one global portfolio. That's where all the accounts are viewed. And there might be some exceptions, whether it's like a custodial account or 520 or, account for a minor will be excluded, but, we'll generally have the accounts and, in one global portfolio, and we'll allocate based on that. And that's, again, as you said, have less tax efficient, investment funds like fixed income or whatever stuff that are paying heavy dividends or whatnot. That will be in the more tax exempt accounts, whereas the growthier, more tax efficient type funds will be in the taxable accounts. And that's, again, just another kind of sort of high touch way we can manage portfolios.
Another one we'll talk about, liquidity management for retirement. This is huge. I only know of one family here that uses us on our hourly financial planning services that's retired, who's doing their own cash flow management in retirement. But basically, if you think of it in three buckets, you have your cash, you have your bonds, and you have your stock. And what we're trying to do is establish a cash reserve. It's a little unique to each family. And we manage the process, but dividends and interest go into the cash bucket. The cash bucket sends out monthly withdrawals as we determine through the planning process. And when the market's up, we take profits. So that's the price increase. We shave off the gains. We put that into the cash bucket. if the market's down like it was in 2022, you don't remove from the cash bucket. You just, you don't sell any stock or bonds. You simply pull down from the cash bucket. So you're protecting your most volatile asset class that you're not selling at the most inopportune times. So that's worth our management fee compared to how other people handle it. And so I think that is another reason why you're investing in low cost ETFs. Yes, that's the vehicle that's being used. It benefits you the most, but it's how you're implementing that strategy is why you pay an advisor for that management fee.
Yeah, and I think just the using Weiser's operation department there, setting up these reoccurring withdrawals, and then sort of not having to do that yourself.
It's like a paycheck. You just get your paycheck.
Exactly.
As long as you don't spend more than your paycheck, you're probably going to be fine.
Right. But the trading aspect and everything, that stuff that goes on behind the scenes, you're not having to worry about any of that. And then, we're not trying to get too cute in certain areas, but we are evaluating the cash bucket as well, whether it's, we use the money market fund for a portion of the liquidity reserve. Sometimes the money market funds yields have dropped, or there's been a more attractive product. So we're also evaluating these different types of cash proxy funds as well. So it's stuff that you don't have to worry about necessarily.
And then that leads to the next big one, which is rebalancing. So you think about 2020, which seems like yesterday, but it's 5 years ago now. But we had
believe it.
We had a big COVID drop. Portfolio bonds were going up in value, stocks were going down, and twice during the year we took gains out of bonds and purchased stock. And then it flipped, market rebounded, and we take gains out of stock and repurchased bonds. Right. Which the whole point was to keep most retirement portfolios in that 60-40 range. And we ended up adding 3% to the rate of return just to the rebalancing strategy. Haven't really needed a whole lot of rebalancing since, because bonds and stock have now been climbing up. We had stocks and bonds down in 22, so they're all kind of moving together. In the last couple of years. This year seems to be, or last year 24 seemed to be a little more normal as far as bonds up, stock down days, right? So that's a huge that's a huge advantage to having professional management, and obviously when you rebalance is important too. So you could be mowing the lawn or hanging out with the grandbabies or whatever, and that's the day you should have done it.
Exactly.
Where that's our job, is to figure out when that rebalancing happens. Also, tax loss harvesting, that's another big one.
Right.
I'd say those are probably the two big ones. And when we prepared for this podcast, I was like, oh, wow, there's like 5 other things that that we actually do to justify managing low cost ETFs.
Yeah, I think, as you said, tax loss harvesting is a big area. For taxable accounts, we can generate tax credits and then again, which reduces future tax liabilities. And that's something that people just really don't want to spend their time on looking at, analyzing, assessing. But as you said too, rebalancing, and the main goal with rebalancing is to maintain your target risk exposure. If you've, if you're a moderate investor and have a moderate risk tolerance, and just say, in the past 3 or 4 years outside of 2022, the market's been up 20%. Now, if you just set it, forget it, at some of these maybe bigger institutions, they'll put you in a model and just leave it. Your risk could be very skewed. You could have a very high proportion to equities, whereas you would like to have a moderate balance. So that's something we're also looking at too, is, when does it make sense to rebalance back to target, and just to maintain the client's desired risk exposures, in case there is a big market drawdown.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
The next topic is something I think consistently about. So, and we've had podcasts on this. What is real financial planning? So at our firm, financial planning is either paid for as a one-time fee or it's included in your assets under management fee if we're managing assets for you. I had a prospect a few weeks ago and I got kind of excited because it was a pilot. We work with a lot of pilots. Most of the pilots just need one-time flat fee planning and maybe a checkup every couple of years. You don't need to be paying an asset manager to manage your 401k. That doesn't make any sense to me. But he had $600,000 he'd saved on his own. So like, oh, wow, this could actually be an assets under management pilot. This makes sense. And then started talking to him and I understand that he wants to buy a house. He doesn't own a house right now. And then I suddenly realized, oh, well, that money that he has in his brokerage account, which would be a healthy investment, should not be invested at all.
Right.
That money should be in cash and be ready for a home purchase.
Right.
And then also creating a savings account because everything was in the brokerage account. And so that's not the normal conversation. I just did some really quick questions and basically told him, you don't need to have your money invested. If the market fell 20, 30%,
right.
But then the housing market opened up for you, you still would be in this same position, if not worse position, because your capital would be gone for buying the house. You end up paying more on a monthly basis, right?
Was that eye-opening?
I think so. He wasn't quite following. I think he's gonna have to think about it for a while. But the point is that's in a very basic form. That was just on a 30-minute consultation. But in a very basic form, that's what planning is about. Maybe you don't need to have money invested, and someone needs to tell you that. And a fiduciary fee-only firm is the one who's going to do it. It's not going to be someone at a transactional relationship organization, right?
And I think just some stories I've heard from the advisor team here is you'll have these clients that come in with huge credit card balances and they might have some money invested in other brokerage accounts, but the interest they're paying on their credit cards is
right.
Far exceeds the return they're getting on their investment account. So it makes
that's actually what's happening in America right now. We have the highest credit card debt ever, which it's over $1 trillion, but we also have the highest savings accounts ever.
Right.
And when you compare the two, you're like, why are you spending 18% in interest and 4%? You get 4% on your savings. There's a lot of people need to do some planning. Those people probably don't end up at a wealth management firm though. They need to listen to like Susie Orman on CNBC.
Yeah. But it's something that does come up and it's nice to have.
Or Dave Ramsey.
Some support saying, hey, or, guiding you in the right direction.
So if you don't have a holistic financial plan in place with your advisor that's managing money for you, then there's a problem. If he has not recommended the right property casualty, if he's not reviewed your estate, your will, power of attorney, medical directives, or recommended trust, if he hasn't, he or she hasn't gotten into retirement projections down to this is what you should be getting on an annual basis, then I would say that you're with an asset manager. You don't really have a financial advisor. You don't have a financial planner. So that's something to think about. And I do think that in the future, there should be a 2-tier system. I think you should pay a flat annual fee for planning and the asset management fee should be very small compared to the planning fee. The industry it's just not built for that. You know, someday if I retired and sold my firm, I would be penalized if I had that fee schedule because that's not how the world works right now in our space. So those are things to think about.
So put a pin in this podcast and 10 years from now when the RA model changes to your vision, then we'll know where it started from.
Right. Exactly. So also let's talk about monitoring and time saving. So if you really want to spend your time trying to figure out when to rebalance, when to make changes in the allocation, the portfolio, go have at it. I think clients hire us to manage assets because they don't want to spend their time doing that. There's other things that they want to be doing.
Yeah. And I have some friends that are, I'd say, more investment savvy, who are very, in the weeds and trying to, trade. But, do you really want to be doing that? Especially as your kids are getting older and getting involved in activities. We already mentioned this, but, at Wiser or at any other RIA, you're having professionals look at your investment accounts daily, and there's formal reviews at investment committee that are discussing these models. So it's just a peace of mind. Do you want to spend your time on Sunday night researching stocks, or do you want to spend time with your family?
Yeah. I would say family time is more important. I don't think you're going to be 80 years old, look back and go, man, I wish I'd spent more time trying to figure out my portfolio.
Yes.
Right. Market communication. Obviously you send out a great quarterly review of what's happened in the market. It keeps people updated. It's really not biased toward active or passive. It's just the facts. This is what happened. Right.
Yeah. And again, I think this is kind of a small side benefit. Obviously you can access communication anywhere, but just to kind of understand our perspective and professionals' perspective on what's going on in the marketplace, what changes did happen in the portfolio. If we do make an allocation change, we'll send out a separate communication kind of highlighting the rationale behind that change. So again, it's just kind of add a little color to the investment side.
And I think the final point is, I don't know, it might be the biggest point, honestly, but when you have a fiduciary partner, your advisor is a fiduciary. I say we spend majority of our time trying to stop behavioral moves.
Yes.
We are in a very polarized environment now where people who are very comfortable in the last couple of years are now uncomfortable because they don't like who the president is, or they don't like who the president has surrounded himself with.
And now, vice versa too. I mean,
yes. And when it was Biden, it was like, oh, this is a terrible economy. This is absolutely terrible economy. I'm like, you're making more money than you've ever made in your entire life. How is this a terrible economy? We're going to do a series. We're working on this now. We're going to do a series on behavioral finance. It'll be a 2 podcast series. It'll come out in a couple of months, but I really want to shake this down, in that people are putting too much emotions into their investing.
Right.
And Vanguard has a great study that shows if you have a financial advisor who's managing your assets, who has full discretion, a fiduciary advisor, you typically have a 3% higher rate of return per year because you have a financial advisor managing your assets. It has nothing to do with financial planning. That's just straight up asset management, which I was kind of questioning. But when you question it, from that perspective, you assume that people have the right behavior. So we have clients right now that want to move their portfolio to cash because, the market's at an all-time high. Well, yeah, it is an all-time high. It's also a 2-year bull market, which typically they go 5 years, right? That was some data you sent me last night. So we have a long ways to go to the upside potentially, right? Also 7 out of 10 years are typically good years for the stock market. You're going to have some bad years. You're going to have some pullbacks. You're going to have 10, 20% pullbacks. Those are healthy. Yep. And if it happens if it happened during the time when your politicians were in office, you feel less concerned that when it happens when the politician you don't like is in office. And there's no correlation. So we spend so much of our time trying to appease people to make the right decisions with their money when they are emotionally biased in so many different ways that have nothing to do with the portfolios.
Yeah. Part of our job is to serve as a coach and just be there as a reminder. Hey, you need to just remember your long-term goals. Remember to stay invested. Do not let the short-term politics or noise affect you. I think we did a podcast on this back in May, but White Charts came out with a good study, showing which Democratic or Republican president was in office going back to 1950. If you only invested when, I think Democrat president was in office, you had to analyze return of like 5%, Republican office like 3%. But if you just stayed invested, it was like, I think, maybe I'm missing the specifics, but it was like 8%.
Yeah.
And that, just over the 75 years, that greatly.
I remember the dollar amounts on that. If you invested
mm-hmm.
$10,000, if you only invested during Republicans, you had 20. If you only invested during,
it was like 70, I think
Democrats,
75,000.
you had 60.
I looked at it this morning.
Yeah.
It was like 400,000 for Democrats and then 3 million just by staying invested.
Democrats and Republicans.
Yes.
You had millions of more dollars more.
Right. and yeah, really, it's just, I think, and we've said this before, it might be easy maybe to time like a recession or and not saying that there's a recession or anything happening, but to pull your money out and go to cash, but it's really hard to get back in, and you're making 2 calls, not 1 call. So it's just better just to stay invested.
The problem is that people don't know they have these biases.
Right.
I was at a conference one time. There were probably 2,000 people there. And a guy doing speaking says, how many of you here consider yourselves to be a good driver? And I'd say 98% of the room raised their hands. We're all good drivers. And he's like, well, that's impossible because statistically 60% of you have something on your driving record right now. Yeah. Right. So it's you think that you don't have biases, but you do have biases. And what I think another one we fight a lot is people have a bias in coming to a conclusion too fast. They think one thing, they think another, they don't do any more research, and now this is the truth. For example, we have a large segment of our pilot base that we consistently have to talk off the ledge on Roth conversions. These guys are already making $600,000 a year, but there's a couple of advisors that are working with these pilots that for some reason it's in their interest to say you should do a Roth conversion. So you're making $600,000. They're trying to get these guys to commit converting $3 million in the year that they're working. So it'd be like they made $3.6 million, pay the highest tax possible in the United States. And there's so many other better ways to be approaching this. For example, you have the 10 years, 65 to 75, when you could do Roth conversions. But anyway, the bias here is that you haven't done the full research. And people think, oh, the government's in debt. Oh, the government needs to do more has to do more to pay these interest on treasuries in the future, right? So therefore taxes are probably going to be like 60%. So therefore I must convert now at 37% because that makes more sense. There's so many other things that they've ignored in their research. What's the effects of AI and productivity? Right. Over the last 10 years, we're 20% more efficient than we were, 10 years ago.
Yeah.
So if we become more efficient, we need less workers. We probably make more money. Right. There's more taxes to be paid. Therefore, you don't have to worry about that. Or something along like Doge comes along, if it's successful, that saves maybe 2 trillion.
Right.
Maybe. Just throwing that out there. But so if something like that happens, why would your taxes have to go up? Your taxes could go down. Might even get a rebate check. Right.
Maybe,
so there's all these different
yeah.
factors that come in. But for some reason, people have this bias of drawing these 2 conclusions and assuming that this is what's going to happen. And now they're going to lose probably another 20% of their portfolio value just in tax because they chose to convert it because out of fear, mostly.
Yeah.
Right. See where I'm going with that? So good advisors are going to be paying attention. They're going to be reading and learning about the future and how this can affect our client base and what we need to be aware of.
Yeah. And I think it comes back to portfolio construction again. One thing, I like being at Wiser is it takes a lot of pressure off my end, having the long-term mindset, but it's the correct mindset. And, we are positioned in portfolios for that long-term view, that 10-year plus review. And, again, not to say we're not going to make changes, but we don't want to be reactive to politics or, one geopolitical conflict that could, disrupt the marketplace for a month or a couple of weeks. We want to be forward thinking in how we construct portfolios. And that's what we're looking at. And that's what we're considering when we evaluate portfolios and, and making changes.
Yeah, I don't want to put you on the spot, but another thing that just came in my mind, we keep getting emails about Warren Buffett and all this cash that he's been raising. I have not read his letter yet. It came out, I guess, over the weekend. Have you read his investor?
I haven't read his letter yet.
He's holding about 20% cash, which is like what, $258 million. It's a lot, but he's been raising cash. So that's another email I've been getting is, hey, Warren Buffett's raising cash. So maybe he's a really smart guy. Maybe we should be raising cash.
Obviously, Warren Buffett's very successful investor. Again, we're building these portfolios for the long term. Warren Buffett, although he's been very successful, will make some more tactical moves and when he raises cash and, getting more dry powder to maybe potentially invest. I don't think that necessarily warrants a change on our end.
Well, first of all, it's 20% of his total positions.
Right.
So you wouldn't be moving your investments to cash. You would be going to an 80 stock, 20 bond portfolio.
Right.
If you're really trying to mimic what he was doing, you'd be 80-20.
But going to the financial planning process, we use Monte Carlo simulation, that looks at all these different simulations, 10,000 simulations, that encounters recessions and volatility and all these, varying degrees of outcome that impacts your portfolio. And so these models from a risk return expectation standpoint, they've been tested. So like we wouldn't want to necessarily make a change because one successful investor is making a change, because these are how these models are constructed in an academic mindset that takes into account all these, different possible situations. So
yeah. Another thing someone says, like, Warren Buffett's not buying the S&P 500 anymore. And I have not seen any confirmation of that, but it would make sense because the S&P is pretty concentrated in the top 7 stocks, which he already has positions in,
right?
Significant positions.
Yeah, Apple.
So he'd just be making it worse by buying the S&P.
Yeah, I think he scaled back on his Apple position, but still, I think he has a decent sized position there.
Correct. So yeah, I again, if you want to mimic him, you're going to be an 80-20 portfolio. You're not going to take all your money to cash because he has 20% of his money in cash.
Yeah.
And also there's enough cash there. He could buy what, the top 2 companies of the S&P with his cash or something like that. I don't know.
Yeah, maybe.
The bottom line here is, even if the market has a terrible sell-off, you're better off writing it out, buying more through buying more shares per dollar than you are going to cash and try to time it.
Yeah. And then going to that point, and we're, again, actively managing the passive portfolios there. We're looking to rebalance. We're looking to tax loss harvest for taxable accounts. So we're actually doing things on our end that aren't necessarily broadcasted.
Yes, exactly. All right. Well, thank you for going through that. I think in summary, why do you hire a financial advisor to invest in low cost ETFs is because, well, you know what? There's a lot of things going on in the scenes that are behind the scenes that you don't see. Through constantly researching new asset classes, constantly researching, do we have the right asset allocation, doing the rebalancing, did the tax loss harvesting, monitoring cash withdrawals. Obviously, we just went through a whole segment on behavior, but helping you hold your hand in times of fear. I get fearful about things I don't understand. So I would fully understand my clients to be fearful about something they don't understand. And my job is to be the expert of that, our team's job. And then I think the big thing is financial planning. Compensation for that seems a little strange, probably to an outsider, but it's just how our industry works. And maybe Weiser is going to be one of the first ones to upset the apple cart here in the next year or so.
10 years from now.
Right. 10 years from now, it'll all be the Weiser way.
Yeah.
But there's many compelling reasons why you would hire a financial advisor. You just have to understand what's happening in the background. So thanks for explaining a lot of that to us, Andrew. You've got some other podcasts. If you want to download episode 191, mutual funds versus ETFs, that's a good one. If you had questions about that during this episode. Other one is maybe you realize your financial advisor is not really working for you. Maybe they're just squeaking out 1% and you only talk to them every now and then. And you don't feel like that your plan is in place. Then
if they have a plan,
Do you even have a plan? Episode 213, how do I terminate a relationship with my financial advisor? That's a good one to listen to. I also have a YouTube channel, A Wiser Retirement. On that channel, we've linked to what is a fee-only advisor? Will AI replace financial advisors? And then how to hire a high net worth financial advisor. Those are all there for your viewing enjoyment, as well as this podcast if you would like. Thanks again for listening. We'll see you guys next week.